Hi, everybody. So while the screens are coming up, just let me take a moment to introduce myself. I'm Shannon Gurick. I've been here with the Community Foundation for about a year and a half. Usually when I'm presenting financial information, I'm presenting on particular financial information. So this is a little bit different. It's more about the concepts and the theories behind it. So looking forward to hearing your questions and seeing how it goes. We are going to ask that we hold questions till the end, just because we have this hybrid format. On a scale from 1 to 5, how financially savvy do you think you are? How many ones? Really not quite savvy yet. Okay, a couple. How many 5s? 3? So a lot in the middle. That's great. That's good. I can't see all of your hands out there in Zoom land, but I'm going to assume that we have a similar disbursement. What are some of the biggest challenges you're facing? A couple that I just have a few here that I'm going to cover today. Managing cash flow, that comes up a lot, I think, in small organizations. Financial reporting, we're going to spend much of our time on that piece because there's so much to it. Knowledge of nonprofit finance. Do we have any people who really think they get nonprofit finance? No. People are raising their hand to say no for people at home. It is. It's a little complicated. It's a little bit different than anything else that people would do. And how about the financial systems you're using? Do you feel like they are really still can't hear me? So anyway, financial systems. In bigger organizations, there's pretty complicated financial systems that help and support. But sometimes in smaller organizations, it's something as simple as a spreadsheet, and so that can get complicated really quickly. So we're going to start with financial statements. And if you've reviewed financial statements before, you know that there are a series of them. The first that you often see is the statement of financial position, more typically called the balance sheet. The next one is the statement of activities, which in not nonprofit accounting would be your income statement. Have you made enough income to cover all of your expenses? There's also a statement of functional expenses. We're not going to talk too much about this, but it really goes into a lot of detail about what types of expenses you have. There's a statement of cash flows. Also not going to talk about the statement of cash flows. It really gets pretty complicated pretty quickly. And it's not, I think people think of cash flows as a way to manage their cash, but it's really not designed to do that at all. So we're going to just briefly talk about it today, but not spend too much time. And then in the bottom here, I put, and let's not forget the footnotes. They're actually the largest part of the financial statements. You think when you're reviewing financial statements, you're going to get 4 statements and you'll be done. But actually, you're going to get this whole booklet because there could be pages and pages of footnotes. The idea behind the footnotes is to give a little bit more explanation of what's going on financially for the company. And they're actually pretty interesting if you ever want to read them. I know they're a little on the dry side, but they really give a lot of information about what's happened in the past year and what the organization is all about. So what can we learn from financials? We've talked a little bit about this already, but the whole idea from looking at financials is to understand how financially stable is this organization. Is it something that is really got some resources to keep it going into the long term, or is it really something that's struggling along? We'll learn about an organization's net worth, how flexible their funding sources are. We're going to talk a little bit about restrictions shortly. What their fiscal patterns are. When's their busy time? When is their slow time? Fiscal philosophies, how do they think about how they record their revenues and how they record their expenses? And to some degree, how capable they are of actually producing financial statements in-house. So to start with the financial position, the statement of financial position. This again is that balance sheet that we talked about. It's really a listing of what the organization owns, those assets, cash, receivables, if they own a building, if they own equipment, computers, things like that. What are their liabilities? What do they need to pay out to creditors, to businesses that they work with? Sometimes, if there's a building involved, maybe there's a mortgage on that building. And then finally, what their net assets are, their net worth that we just talked about. And that can be divided two ways. With restriction, so meaning a donor has come along and said, geez, I want you to use this for X. And those without restriction, which of course gives them much more flexibility so that they can think about how they use it for their purposes and their priorities. And so here is a balance sheet, or I always call it a balance sheet. A financial position is what it's technically called. And you can see there, this one in particular is classified, meaning they list their current assets first. These are the ones that could be turned to cash most quickly, followed by investments in property, those things that you really don't want to turn to cash so quickly. Underneath are the liabilities. And interestingly, Megan, who I think is here behind the pole, said to me this morning, really, you add liabilities and net assets to get to a total? I would think you would take assets, subtract liabilities, and get to net assets. But that is not the way this works. It's not. It doesn't work the way you think. And the idea being that the two sides of the balance sheet total and equal each other. That's the reason behind it. So, something that I would point out on this statement, you see the red box at the bottom. Their net assets are all sort of classified as with donor restrictions. And that means that they have restrictions on how they can spend it. It's not something they can do all on their own and make those decisions. And the amount without donor restrictions is actually overdrawn. That's not good. That means they have pretty low levels of flexibility. So when you're thinking in reviewing financial statements, you might think about this section in particular to understand what flexibility the organization has. Okay. Statement of activities. This is the fun one. I know some of my finance staff are out in the Zoom, and this is the one we spend the most time at year-end trying to figure out how to make it balance. But generally what the statement of activities is really looking at how did we perform this year? What were the revenues that came in? How were they broken out? Where did we spend our money? How much grants went out the door versus how much did we spend on operations? And it really tells us what the net operating results for the year are. In our particular case, excuse me, gotta get a drink of water here. In our particular case, our financial statements don't have an operating measure on them, but we do keep track of it pretty closely as we're going throughout the year. The next section that's really kind of complicated are the revenues released from restriction. So when we think about those donor restrictions again, we think about a donation comes in for a particular purpose. Did we spend it this year for that purpose? And if we did, then we release it from restriction, and out it comes from our net assets. Anything that came in for a restriction that we didn't spend actually gets carried forward to a future year. So I think, well, I wanted to talk a little bit about donor restrictions first before we get to the statement. Donor restrictions, you can't use them for just any purpose. They must be used in accordance with the donor's restrictions. But the important thing that I wanted to point out here is the very last line. Only a donor can restrict something. If the board wants to say, we want to use this for a particular purpose, that is designating it, and it's very different than restricting. Expense categories. So one thing that's important when you do a statement of activities is determining what types of expenses you have. And there's two different ways of categorizing them. There's what we call natural classification, which really is saying, what was the type of expense you had? Was it a salary? Did you pay rent? Was it heating the building? Things like that. And then the other way that you can classify them is by functional areas. So was it for a program? Was it for the overall administration of the organization? Or was it for fundraising? And you have choices to make in your financials about which way you want to show these expenses. And so when you think of a statement of activities, there are several columns. One is with donor restrictions. That's the middle column. And it's the one that really, I think, is most focused on when people look at these financials. The without donor restrictions, again, is where all of the flexibility comes in, where you get to determine, how is that used and what will it be used for. This particular statement is by functional classification, meaning the expenses are by programs and then by management in general and other. The statement is also showing an operating line, change in net assets, which is called operating results here. And you can see that in this particular year, the operating results were not so good, right? They're overdrawn. They had more expenses than revenue. And so that's something to consider when you're looking at these financial statements. So I want to talk a minute about the hierarchy of financial reports. So if someone hands you a set of audited financials, you know that an auditing firm has taken a look at them, they've looked at the underlying transactions, and they've assessed whether these financial statements are fair, meaning they have good documentation rolling up to support them. Below that, and a little less expensive, are review or compiled financial statements. This means that there's still an accounting firm that's looked at them, but they haven't done a lot of that underlying testing. So better than not having anyone look at them, but not as supported as others. And then the bottom section are things that could go a little either way. Internal budgets, internal balance sheets, those are things where internal staff are creating them, working with them, and pulling them together. And the final is the IRS Form 990. This is also comes from those internal statements, but could either be reviewed by an outside firm or created by an outside firm. And so again, depending on if they have that review, tells you a little bit more about how much you can rely on them. The basis of all of the financial records that we just talked about are the underlying records, the financial planning that's gone on in an organization, the controls that have been put in place, and all of the background and supporting documentation related to those. So we're going to talk a little bit about that next. Designing internal controls. Does everybody feel like they know what internal controls are? We accountants love to talk about internal controls. Okay, good. So we're going to spend a little time talking about them. So, generally in an organization, there's lots of policies. Many of them are approved by the board of directors or the board of trustees. And then there's procedures that the staff use to keep track of all of the things controlled by those policies. And when we talk about internal controls, what we really are talking about are those checks and balances to make sure that we are working in accordance with those policies and we're following our procedures. So we have lots of different accounting cycles that we use, that we think about: payroll, accounts payable, money coming in, money going out. And so what we want to do when we design internal controls is we want to really think about, well, what's the process? When a check comes in, what do we do with it? We want to identify any risks, right? Is it made out to Shannon, or is it made out to the Community Foundation of Western Mass, right? We want to make sure that we minimize the risk that somebody could take that check and cash it. And then we want to overlay a control to be sure that when it comes in, it gets processed in the way that we want it to. So just to give an example, my favorite one to use is always payroll. If Shannon is the only person on the, thank you so much. If Shannon is the only person who's touching payroll from start to finish, then how do we know that there are good controls in place, that Shannon's being paid the right amount and Shannon's paying everybody else the right amount and that it's going to the right bank account and all of those sort of things? So one of the key things in internal control is that segregation of duties, making sure that there's more than one person involved in any specific cycle. So just to give you just another for instance, right? In our payroll here at the Community Foundation, we have about 3 people involved. We have someone who sets people up, we have another one who runs the payroll, and then a third person who actually approves it after it's been run. So when you think about designing those internal controls, it's really about getting more people involved in the process, even if they're not sometimes they're not even part of the finance department, right? It could be someone even outside of the finance area. So up to now, we've been sort of looking back. We've been saying, financial statements are a look at the past. You don't create financial statements in the middle of your fiscal year. You create them after you're done. Here, now we want to turn a little bit to financial planning and looking more at where we're headed. And so, so when we think about financial planning, we're really looking at where we're headed, and we often want to think about more than 1 year ahead. So I just have a slide here of why create multi-year plans. Well, you really want to think about how your operation is going to get to really accomplish your strategy. And sometimes, always, right, that takes more than a year. So you want to think about setting a plan that gives you a direction. You also want to be able to plan for long-term issues. So if you know something's going to come up in a couple of years that's going to cost a lot of money, you want to start thinking now about how you might pay for that. When you think long-term, you think more about financial stability and not just trying to get through this year. And it also gives you some room to think about multi-year grants and how they might work into your operation. I need you to come and peek, and that made me get it. So there's many types of budgets. You can have just a simple operating budget that talks about your operation and how that will work. Sometimes you have a cash budget so that you can manage your cash, make sure that you're timing revenues coming in and expenses going out so you don't run out of cash. Sometimes you have a program budget based on an individual program within your organization. Grant budgets can be very specific and require certain types of expenditures, and you'll want to keep track of those. And then you may have a capital budget, which is about, what are the big capital things you need to buy. Perhaps you're working to build a building or buy a building or something like that, and you'll need more time to plan for that. An operating budget could really include any or all of these. Many organizations decide what they want to put in their operating budget, and what I would say is that each individual organization should make that decision, but also should understand that excluding something doesn't mean it's not going to happen. So you want to be able to be sure that you're tracking all of your financial activity and not just excluding things that maybe don't get you to a balance or don't or help you to ignore something that you should be focused on. Does that make sense? So when I think of a budget, I think of a 1-year financial plan, and I think about it around the course of our fiscal year, or whatever fiscal year you're working with. And oftentimes that has a cycle to it, right? Where, a few months before it starts, you start planning for the year ahead. And with a budget, you should do the exact same thing. You don't want to start on the first day of your fiscal year and say, oh good, let's work on the budget. So the suggestion here is to really start well ahead. Start thinking about it almost the minute you finish last year's budget, you want to start thinking about the next one. You want to have a lot of discussions with key stakeholders. And for different organizations, those stakeholders may be different, but some are board, management, the staff, the people who are running the programs really probably have a good sense of what they need to run that program. When you think about revenue, this is probably the hardest one. You want to record revenue that you reasonably expect will come in. You don't want to, say that you must have firm commitments in order to record it as revenue, but you really want to have a pretty good sense that it's going to come, because if you don't, or if it doesn't follow, right, you may have set all sorts of expenses based on a certain revenue target. So you want to be sure that you're setting something that's achievable. Past experience is probably a good guide here, because you know as you look back over a few years that probably a lot of came in that you knew about, but also some other things might have cropped up that you weren't prepared for. The expense side is really easy. It's really easy to spend money. So, in that category, we have fixed versus variable. Fixed expenses are things like rent, utilities. I have put salaries and benefits in the fixed column. Some people don't agree with that. They think of the ability to reduce employment contracts as a way to reduce expenses, and sometimes that's what has to happen. But I put them there just for this example. And then there are variable expenses, which could be programming, discretionary spending, things that you could stop doing if you had to. And then finally, when setting your budget, you really want to think about contingency planning. If revenues fall short, what would you cut? What would you stop doing? And is that enough to cover, to keep yourself in balance as you go forward? Also, if one revenue source dried up, where might you go to get some revenue to replace it? And how might you change gears is something really to think about in your budget. And anyone who works at the Community Foundation knows that this is my favorite slide with my expenditures heavier than the revenues. Finalizing the budget is always challenging because it's really easy to spend, not so easy to get the revenue in. But the important thing here is once you have it established, you really want to monitor it. You want to be sure that you are keeping on track, that things aren't popping up that you're not prepared for. And as I mentioned right at the beginning, almost as soon as you have that budget set, things are going to crop up that are going to impact future years. And you'll want to start planning for that next budget almost immediately. And that's it. And I think that means we have plenty of time for questions and discussion. Yeah.
Can you talk a little bit about reserves? And I know most of us probably work for nonprofits, and the philosophy is you're not amassing funds for stockholders or stakeholders for distribution in that manner.
Mm-hmm.
But what's a reasonable policy about amounts of reserves and and decisions about how you use them?
Mm-hmm.
Maybe to repeat the question for those online.
Sure thing. So the question is about reserves. What's the right level to have? How do you think about those right levels? And also uses, was that one of the questions as well? So there's lots of ways to determine how much in reserve you have. Sometimes it's based on your assets. It could be a percentage of your assets. Most times, though, I think it's based on a percentage of your revenue, of your annual revenue. So the idea being that if your revenue dropped by, let's say 40%, for instance, that you have some way to get through the year without that revenue. So what I've seen pretty regularly is somewhere between 40 to 60% of annual revenue as a reserve, an operating reserve, that is. It can be challenging to get there, though, right? So you want to put in place a policy that helps you to get there versus one that says you hard and fast need to be there at a given moment. There are also other kinds of reserves, like reserves for a program that's coming up, or reserves for perhaps purchasing a building, as we've used as an example a few times. I think they probably all need a policy of their own because they just don't act the same way. You're welcome.
We have some questions in the chat.
Okay.
Oh, so can you explain net assets again? I find them confusing on the balance sheet.
Yes. So net assets. So let me let me back up a little bit and give a little bit of a history of nonprofit accounting and fund accounting. Sounds exciting, doesn't it? So way back, about 20 years ago, not-for-profits used a kind of accounting called fund accounting. We still do it here at the Community Foundation, and many not-for-profits still do it, sort of track their books that way. But about 25 years ago, the FASB, the Accounting Standards Board, really wanted to change things to make it so that not-for-profit accounting financials looked more like for-profit, so they didn't seem so different. And that's when they came to this whole idea of net assets. And so over the years, net assets have changed. When they first came up with the net assets, they were in 3 categories: unrestricted, temporarily restricted, and permanently restricted. And then several years ago, they combined temporary and permanent and just now call it donor restricted. And so the idea was to simplify things, but in reality, if you had just sort of got off fund accounting and into net assets, it suddenly was like, well, now what do we do, right? It seemed like you have to figure it all over again. But I think the basic bottom line is that net assets are divided into 2 categories: those that donors restrict and those that they don't. And that's sort of the basic rule to use when you're thinking about net assets and revenues and expenses that are coming in and going out, to be sure that you get them in that right category right as they come in the door. And really just keep it as simple as that: donor restricted or not donor restricted. Oh, yes,
You said something.
question in the room.
You said something before about the board can designate, not restrict.
Mm-hmm.
I have on our board. Can you talk a little bit more about what that means? Is that binding in a different way, or is that a recommendation?
Mm-hmm. So the question is related to board designated versus donor restricted, and how they act differently. So what a board can do is they can take unrestricted money that came in without a donor restriction, and set it aside for a particular purpose, and that is what designates it. I think the higher restriction is the donor restriction.
Mm-hmm.
Those are, only the donor can change that, or the courts, or some other very difficult way of unrestricting them. For board designated, though, a board can change their mind. They can say, geez, we set this money aside for something, and now we've changed our mind. We want to use it for something different. So the board has the authority to make that change, but it's the board that has to make the change. I, as a staff member, can't make that. I can't change it. I can make a proposal. I can make a recommendation, but you really need the board to change the designation of something.
And are there boundaries around time for that, or is it as simple as like someone could go to a board, the ED could go to a board meeting and say, our circumstances are shifting, can we use these funds here instead of here?
Yeah, I don't think there is a time restriction. It's more about what the process and procedures that are established by that board.
Thank you.
Yep.
We have a question in the chat about the balance sheet.
The balance sheet, yes.
We're wondering if we could share that first slide again. The question is, how do you get to the bottom line when you don't subtract the expenses from the revenue?
Okay, so the balance sheet is the asset and liability statement. So I think maybe we're talking about the statement of activities. It's about the 5th or 6th, I would say. Resume the slideshow, maybe, see if we have up toward the middle of it. Actually, yeah. Don't look while I flip. So, and I'll admit, Diane, do you? So, this is the balance sheet. And it's really divided into two sections. So the top section are the assets. And the idea is that the assets equal the liabilities plus the net assets in the bottom section. And I think maybe where the question is coming is related to the fact, just as Megan had suggested, right? Many people think of assets minus liabilities equal net assets, but that's just not how this statement works. Although it works both ways. The math works either way you do it. But the idea being that, you know, this, I wish I had a pointer. This line of total assets of 542, 532 is equal to the total liabilities and net assets, also 542, 532. They have to equal, otherwise you're not in balance. And always, hopefully, right, there's some significant amount of that total assets are part of your net assets, meaning they're your wealth to be used in future years.
I'm checking to see if that
Okay.
answers your question. Another question, can you talk about the interaction between operating budget and capital budget? Are capital expenses reflected in the operating budget?
So the question is, how does an operating budget interact with a capital budget? And are they the same? Do you put them together? How might you keep track of those? So generally a capital budget is more than 1 year. It could be many years, right? It could be a 10-year plan, it could be a 5-year plan. And what I would say is that your operating budget, your budget for the current year, should include the activity that you need to do in order to make the capital plan happen. So, for example, let's say in the first year of your capital plan, you buy a building. Your operating budget should include the depreciation of that building for the first year. It doesn't necessarily include the purchase, because that's in your capital budget, but the ongoing expense of operating that building should be in your operating budget. I think many places think of budgets differently. They might think of them as two very separate things, but some organizations like to put all of their activity in their budget. We at the Community Foundation do. We have a budget that includes all activity. Some of it is non-operating and some of it is operating, but it helps us to keep track of all the activity during the year.
We have folks who are still confused about the previous question, so I'm just trying to figure out if we may be able to get them on mute and let them
Yeah.
speak.
Oh.
If they unmute, I believe we should be able to hear them. Maybe stop sharing.
Yes, while we figure that out, one question is wondering if you're supposed to have reserves, where those, and where do those show up on the balance sheet?
Good question. So the question was, are you supposed to have reserves? And if so, where would they show up on the balance sheet? I think it's good practice to have reserves because it really helps you to iron out any bumps in the road that come along during the course of a year or a longer term period. And so it is good practice. I think some, depending on what you have available and how conservative your board is, may help determine how large or how small those reserves are. Where reserves show up in the balance sheet is in your net assets. Reserves are essentially accumulated net assets that you've earned in previous years, in theory, or unrestricted gifts that have come in that are being sort of saved for a bump in the road. And so they end up in your net assets over time.
I can unmute individuals.
Do you want to,
I think they can unmute themselves.
Can they?
So if somebody has a question, they can unmute.
So I think on Zoom, if anyone has a question, you could unmute yourself and ask it.
Or if they need to type their name in the chat, I could probably unmute them.
Or you could type your name in the chat and we could unmute you.
Can they raise their hand?
Or raise your hand.
William is unmuted.
There's William, okay. There you go.
Great.
Thank you.
I'm a bold one on the scale of 1 to 5. So the balance sheet is still a little confusing to me, and you know, I hope for the 101s out there who were just, I don't know. But Heidi very helpfully said, maybe can you use an analogy to the balance sheet, like if you own a home and you have bills, bank account, what are the net assets, liabilities? It might help us who are really struggling with just
Sure.
more basic concepts here.
Yeah, yeah. Well, I'm going to take your example then, since you suggested it. So a way to think about a balance sheet, right, is we will assume that Shannon owns a house. She has a checking account where she pays her bills from, and she has a retirement account. I'll just make it a little more complicated, that I have a retirement account as well. And so when I think of my balance sheet, my liquid assets are my cash, right? Whatever's in my checking account on any given moment. My longer term assets are my house, the value of my house, and my retirement account. I have a retirement account. It could be very liquid, but I really can't access it for a number of years. So I can't call it a current asset. On the liability side of the equation, I have a mortgage on my house. And so on the liability side is the amount that's left of my mortgage. So just to use an example, let's just say my house is worth $200,000 and I have a $100,000 mortgage. When we think about net assets, what's the worth to me, it's really thinking about those assets that aren't encumbered by a mortgage in this case. And so my net assets are the cash account, the retirement account, and the net value of my house, so $100,000. So if you think of it from that perspective, and then switch over to the statement of activities where you're recording revenues and expenses, right? I've got my paycheck coming in, got my expenses going out. That's really the activity that happens in those accounts over the course of a year. To make it just take another level of complexity that doesn't happen generally for an individual though, is that maybe someone wants to give me a gift and they want to restrict it to, I don't know, if I were a not-for-profit, they'd probably want me to grant it back out to the community. So I've got some gifts on hand that I haven't granted out yet. Those would fall into net assets that are donor restricted. Not so much the personal example, but just to bring that complication in as well.
Could you make reference to accounting systems that seem to be user-friendly for nonprofits? I mean, whatever type of program that's computer-based?
Yeah. So, as a community foundation, we have a very specific accounting system that supports community foundations. And so I don't have a lot of experience with other types of systems, but I have heard that QuickBooks is one that can really help a small business. Depending on your size, there are often bookkeeper companies who can help you. You can sort of outsource the work to a company that will do it for you. I think Excel is probably a little too simplistic for most businesses, but I think something like a QuickBooks or maybe even a Sage might be opportunities. But if you reach out to some of those companies, I think they would probably have some good recommendations for you. Here in the room?
So we are currently a program under another nonprofit that's spinning out. So we have grant budget, 2 program budgets. Where do we get started for getting our sea legs as our own nonprofit? Financial statements and planning.
So,
Can you repeat the question?
yes. So Megan, I think it is with an organization that is currently working as a program under another organization. the other organization is spinning off, and so they will become a standalone organization. Is that right?
Our own nonprofit.
Their own nonprofit. Exciting.
Congratulations.
And so how do you get started? How do you set up the systems that you need? So I would suggest that, first of all, you probably need a lawyer to help you with all the corporate
Check.
stuff.
Got it.
And you want to be sure that the assets that you're starting with are categorized appropriately, meaning that, again, that donor restricted and not donor restricted, because this is your moment to sort of do whatever research is needed. And then I would suggest, reaching out probably again to an accounting firm to help you think about what the good starting points are. You'll need bank accounts, right? You might need some sort of bonding in order to be able to do business with certain entities and organizations. You might think about using an outsourced HR provider or payroll provider, so that you don't have to sort of set up a whole payroll department right as you get started. So I would maybe think through which partners would really ease the transition. Even if you don't use them long term, they can really help you think about good ways to set things up. They have sort of general rules that they use across all of their clients that help to give you those good starting points. Yes?
I have another question. Do nonprofits use profit and loss statements, or is there something that you've already reviewed that's comparable to that?
So the question is, do not-for-profits use profit and loss statements? The profit and loss statement is really the statement of activities, and it's segregated much like a profit and loss, with revenues at the top, expenses at the bottom. Some of you that go way back in fund accounting might remember where it used to be expenses on the top and revenues on the bottom. Anybody remember that? It was really confusing. So the idea of the statement of activities was to try to make it look more like a typical profit and loss statement.
I have a second part.
Sure.
What is a variance report?
A variance report could be a lot of things, but what I would guess in this context might be if you've established a budget and you're comparing it to actual, that the
That makes
variance
sense. Yeah.
is where you're either, I was going to say off track, but where you aren't coming in accordance with that budget. Yes?
I have another question. So flipping to my board member hat, how do you get a board member or your board up to speed on financials? Because I've definitely felt like deer in the headlights as a board member before.
Yeah, so the question is, as a board member, how do you get your board up to speed on financial matters, essentially? I would say that the best way to do it is to have a set schedule of times during the year when you bring financial information to the board. Times to do that might be, again, as you're setting your budget before your year ends. It's probably shortly after your year ends, so you can provide results. And it may be at a third point in the year when you're starting to plan for the next cycle. But I think bringing information to them regularly is helpful, because it sort of becomes a little bit like muscle memory, that they know at this time of year they look at this part of the financial picture or a different part given different times of the year. I don't know if there's a finance committee connected with the board that you're discussing, but oftentimes a finance committee is bringing information to the full board as well. And they too, right, have a role to play in making sure that the full board feels fully informed on the financial matters. Sometimes you can find that board members will say, oh, the finance committee has this, it's too complicated. But the reality is that all board members have a fiduciary responsibility. And so really thinking about how to get sometimes non-financial people to understand the financial information is really important.
And what are some strategies to support their learning so they don't just glaze over, or I don't just, you know what I mean? Like, how do you catch them up to speed so they're comfortable talking about it, asking questions?
Yep. So the question is strategies to keep the board informed and to get them up to speed on financial matters. Well, I can tell you how we do it here. We have an orientation with all of our trustees when they come onto the board to give them a sense of lots of things, not just financial, but to be sure they understand some of the financial matters that impact our organization. Ours is a little bit different, right, than probably any other. Each one will have its own thing, right? And then we do, we invite all board members to come to our financial committee meetings just to try it, see what it's like. And we also do an orientation to each of those committees. So we give them lots of opportunities to come and learn a little bit about it. And we find that once they sort of have the basics, that it comes, they can tune in because they understand enough about it to know what we're talking about. So I think it's just that repetition and making sure that there's opportunities when people have a question, you can say, oh, hey, I'm doing this orientation next week, you should come, that kind of thing. Yes?
Sort of weird, but I might add to that answer a little bit. Okay.
Do you want
I probably shouldn't even do this, but.
We know you love the mic.
I do love the mic. Hi, everybody. I'm Megan Burke at the Community Foundation, and I'm giving Shannon a chance to have a little quick sip. I would also say that the executive director or the president of any organization should also understand the financials, even if they don't have a financial background. And I say that as someone who does that here without sort of obviously the depth of experience that Shannon has. I have to understand at a level because I also have a responsibility as part of that control system to make sure I understand what our finance department is doing and that I can also communicate that to the board. And so sometimes having that, I don't know, if that person who is the lay person who also has to help explain it to the board can help to make sure that it's being presented in a way that is understandable to someone who is a sort of financial lay person. And I kind of joked about this in the back, but the other way to help make sure your board understands is to hire someone who is as awesome as Shannon, who is really, really good at explaining these things in terms that aren't super technical, so that the board should really be able to understand it, and there are ways to communicate that. So, thank you.
Can I add something? Sure. I feel
We don't
weird.
hold that way.
Yeah, I don't know, like put a selfie. So I just want to add that I think that it's a question. I'm Jeff Markham. I'm a program officer, so I work a lot with nonprofits. And one of the things we like to think about are governance and the boards of organizations and how do we develop capacity for them to do the work they're supposed to do. But what you're pointing out is something that we need to think more intentionally about as people who develop capacity-making strategies for nonprofits. And not only is there the governance issues that happen within organizations and their boards, trying to diversify, all those issues, but then when you bring people with different experiences into the room, how do you set them up for success, right? And so I think we are thinking pretty intentionally about how to develop strategies to give to nonprofits. So aside from grant making that we do, what are the teaching opportunities that we can develop and bring boards into that are newer, have less experience in this particular part of doing the work, and set them up for success. So that, I mean, that's work that we're thinking about over the course of the next year. This is part of that conversation, right? Doing this financial statements 101 for executive directors, for board members, and then we'll continue to develop that muscle as we progress through. But I appreciate that question because it's something that many nonprofits are thinking about right now. Okay, we'll take that. Thanks.
Yeah, and to just raise a resource for the folks in the room, folks online are talking about TechSoup. If you don't know about TechSoup, there's a lot of great resources and discounts for things like QuickBooks and other.
I was telling our new data person about TalkSoup, and she said, oh, I went and looked for TalkSoup. I'm like, she's like, I think it's TechSoup. And I'm like, oh, I think TalkSoup was a show several years ago. covered everything in the chat? Okay. Great. Well, thank you all. I'll turn it back to you.
First of all, obviously, I want to thank Shannon for just a tremendous amount of information in a very short amount of time period. For those of you that might be feeling, oh my gosh, I'm still overwhelmed, that was a lot of information, I don't know what some of those things were, that's okay, right? Like, the first time we learn anything, we're not going to be instant experts, right? Otherwise, we'd all be superstar basketball players and amazing bakers and like all the other things that we get to try to do. But our goal is to continue to be here for you, to be able to answer questions that range from, I got a document, I don't understand it, to, I'm starting a nonprofit, right? Like, what are the other things besides finances that go with it? So really appreciate everyone that was here online, that was here in person. Again, we had a tremendous just reaction to this, and so it is being recorded. It's now on our Facebook page. We'll also be posting it on our YouTube and on our website. If you have questions that you feel like you still need it asked or you want some follow-up, please let us know. Your feedback from us directly shapes the subsequent programs, the subsequent resources, what we surface for you. And as always, you can always reach all of us at the Community Foundation, but particularly the Community Impact Team. We're at grants@communityfoundation.org. Always looking to connect with more folks. Can always set up time to chat, to come visit you. And again, thank you everyone for coming out today.